Here we'll talk about what Peter Lynch, the famous mutual fund manager, has to say about investing, how he dealt with picking up stocks, and how he saw the investing world, markets, etc. in his times, and what we as investors can learn from him. So agenda is very simple. First, I'll introduce him, and then I've mentioned some comments or his quotes from his books, from his articles, from his interviews, and then with that, I have added my commentary in this video to explain you better in today's context. So here it's about him. He started managing Magellan Fund at the age of 33 and managed it for 13 years, generating more than twice the return given by a market, S&P 500, 30% CAGR. And after the end of his career, he wrote his book, books, one of on Wall Street and Beating the Street. There's one more called Learn to Earn. I read these books when I was just starting in the investment world and learned a great deal from them. Uh, Nowadays, also, I'm repeating or rereading these books, both of them, One Up on Wall Street and Beating the Street. I'll encourage you, in fact, recommend you that you must read these books if you're, even if you're starting in the investing world or you think that you have spent some time and learned the basics. Still, these books will do good for you as an investor. Here are the tips. As I said, these are quotes by him, either in articles, books, or in the conferences or interviews he has been part of. So, first pertains to timing in the market. As per him, if you can see, the summary is that timing the market is futile. If timing the market could generate substantial returns, then you would have seen the best, the richest people on top of Forbes list as market timers, which they are not. The best known investor called Warren Buffett, who has amassed a huge wealth from stock market only, is not a market timer, and you all know that. He never timed the market. Second point tells about people who are scared to go either enter into the market or think that no market has reached all time high, it can't go higher, it can go only down, and then if I put money right now, my money will go down, etc., etc. He says that in case you are scared of declines, you'll miss the next rally. So don't, I mean, you must have a stomach for it. Your portfolio will go down. You shouldn't worry about it. But in case you can't handle the volatility, Warren Buffett also said that in case you can't see your portfolio going down by 40-50%, you shouldn't be in stocks or equity mutual funds. They will go down. Nobody can deny that. I mean, from since the start of say after COVID, we have seen only up and up and up, and everybody is saying that markets have reached all time high and nobody has seen the declines. It will go down, and when it goes down, you don't have to lose your mind, don't lose your head. Just keep on investing, finding out the opportunities where you can invest, and uh, keep on doing the same thing which you have been doing. Just stay invested, as per Peter Lynch. Now, again, regarding market timing, he has given the data, and this I think I indirectly referred in the video I made for timing the market versus time in the market. He says that if you somehow miss 40 key months in the past 40 years, your annual return goes down from say 11.4 to 2.7%. So, and nobody could tell you that these are the 40 key months. So again, he through this quote, he's referring to the futility of timing the market. He emphasizes that time in the market. He says that again, that suppose you started investing in 1965 and you kept investing till 1995 for 30 years. Suppose you, in one case, in one scenario, you picked the stocks on the best days of the market, and in another scenario, you picked the stock or made the invested in the during the worst days in the market. At the end of 30 years, your difference in the returns will be 1.1% only. So this timing business, that not this time is right, this time is not right, I should wait, I should immediately deploy, is futile. It's like the last sentence says, this timing business is much ado about very little. It doesn't add value. Don't pay attention to it. Now, again, the second comment he made in a conference in 1993, he he mentioned about what has happened in 1900. So as per him, uh, market has seen 53 corrections of 10, at least 10% in the last nine decades, 90 years, and 15 of those corrections were of 25% or more. So roughly one every 6 months, every 6 years, you'll get a correction of more than 25%. And these are the setbacks, or say portfolio going down by more than 25% is normal. It comes with the territory. The terrain is like that. If you are in the equity markets or mutual funds, your portfolio will go down. You shouldn't be scared of that. In fact, you should prepare, and as I mentioned in my last video, keep some cash handy in case market goes down, and you see the opportunities. Deploy that excess cash with you. It will give you, or it will add up to your returns in a very substantial way. So don't be scared of market going down. It will happen. Nobody can deny it. Nobody is untouched. Even Warren Buffett's portfolios have gone down many times. So don't get scared of them, and choose the investments wisely and use that opportunity. Now, he has, again, in the last quote, he has mentioned, or given a scenario that suppose we are in long recession and earnings go up by 4% a year, and then companies choose to give 2.5% dividend. So total returns are 6.5%. Assuming it won't happen, hasn't happened, but assume that, still you'll get 6.5% return on your equity investments, which is much better than, or not better, not much better, but still better than 6%, which is provided by the corporate bonds. This is he has said in the American market context. So you should focus on earnings. If you believe that the companies you're investing, or the company directly, or companies you're investing via your mutual fund, the earnings are going to go up. You shouldn't worry about the small, short-term ups and downs in the stock prices. In fact, his focus is, you should worry only about the earnings. Are the earnings going to go up or down? Now, my thought is that along with earnings, you should pay attention that not too much of equity dilution is happening. If you see the Yes Bank's case, Yes Bank, it has got the valuation right now, which is same as the valuation it was getting at the time of Rana Kapoor, Mr. Rana Kapoor, uh, before he went to jail. So valuation has come up, earnings have come up, but during these 3, 4, or 5 years, they have diluted too much of equity. A lot of new shareholders have come up, which have put money in Yes Bank as company, and because of that, though the market capitalization is same, valuation is same, because of too many issuance of shares, that means equity dilution has happened, and people who had invested at the levels of 230 or 140, still uh, to see the stock price coming up in three digits. Right now, it's hovering at, I think, 22 to 24 rupees per share. So they are yet to get their money back. So as investors, you should pay attention to earnings, 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 but keep in mind that earning should come not at too much cost of the equity dilution. That you have to take care. Here are in the last quote. Remember, things are never clear until it's too late. On yesterday only, he sent a proposal to an investor who declined it, saying that he will wait for the outcome what Iran does to Israel in coming days, and after things get clear, he will take action. So I and this quote is dedicated to him. You won't get any clear thing. There will be uncertainty in the markets. I mean, something or the other will come up. Today is Israel or Iran. Tomorrow it can be anything. India and Bangladesh, India and Pakistan. Who knows? Can be anything. So don't worry about that. If you think that corporate earnings are gonna go up without too much of dilution, everything's working in India's favor. Not too much effect will be there of all these ongoings in the world. You should invest. Now, the first picture on the left top, again, it says that people who keep on waiting for corrections, they in long term they lose money, and they don't realize it. I mean, that's what he's saying. Essentially, is that more money is lost in preparing for corrections or anticipating corrections, but than what is lost in actual corrections. So don't worry about the corrections. If you have patience, if you have done your homework, if you are investing via SIPs, if you have cash handy, whenever market you see at appropriate levels, or if you see going via SIP, you keep on investing. Don't worry about this noise, I would say. That's what essentially he's saying. Second, bottom on the left talks about the economic analysis. Today only I was talking with a friend who was asking my opinion about RBI keeping the repo rate same. I said I don't have any view. I don't care about it because uh, first of all we don't have any control on it. RBI governor is not gonna listen to you. Fed governor is not gonna listen to you that what should be the interest rate. They'll do as per their wish. So you should find companies or mutual funds or find fund managers who are buying companies irrespective of what Fed is doing, what RBI is doing, or what government is doing. They should buy companies, or you should buy invest in mutual funds which has companies which will do good irrespective of who is at center, who is in the government, who is in the Fed, who is in the RBI. That's what essentially Mr. Peter Lynch is saying. And lastly, I've seen people, because of too much of trading and short-term gains focus. A lot of people expect that if I invest today, I should how much money I'll be, or how much return I'll be getting in, say, 4 weeks or 10 weeks or even 2 weeks. My suggestion to them is to look at the comment quote on the right side. He says that my best stocks have been given me return, have given return in third, fourth, or fifth year, or maybe later. So, a fund manager, when he selects companies, he uh, typically select companies which are going to give him returns based on some hypothesis that this company is expanding, so it will capture market here, or maybe coming up with a new product, it is increasing capacity, or maybe reducing debt, doing this, doing that, maybe increasing efficiencies, or hiring correct set of people, launching a new business division, maybe automating a manual line of business. So these things, I mean, take time to come to fruition. And again, even if they have come to fruition, market takes time to realize that no, the nature of the company has changed, and re-rating has to happen for a particular stock. So things take time. In nutshell, things take time. So don't worry about what your stock or mutual fund NAV is doing in short term. If you believe in fund manager, discuss with your advisor. If you believe in fund manager, if you believe the management of the companies you have invested in, give them time. Eventually it will reflect in stock prices. That brings us to the end of this video. As always, if you want to discuss anything more on that, I have read a lot of books by famous investors like Benjamin Graham, Warren Buffett, Peter Lynch, of course, uh, Monish Pabrai, and others. In case you want to discuss more, you can WhatsApp me on 80889238849. You can call me on 966 352 0068. And you can email me on ashish at kubercap.online. Thank you. Happy New Year.